Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, one of my favorite investing lines comes from none other than Warren Buffett. Investing is simple but not easy, said the wizard from Omaha once. Well, I completely agree with him. Come to think of it, you need to perform only two functions when it comes to investing: checking out the business quality and checking out the valuations. Well, this 2x2 matrix will help throw more light on this. Now, I'm simplifying things a bit, but I hope you get the gist. Your focus should be the bottom left compartment that's colored green, where you are buying a good quality business at not so expensive valuations. If the business is of a very good quality, then you can get away with expensive valuations. This is the reason I have colored the bottom right compartment yellow, where you need to get the business quality right if you have to have any chance of making money over the long term. Coming to the top left and right compartments that I have read, these are danger territories. The one where there's a strong chance of making huge losses if you're not careful. I don't think you should ever buy a bad quality business even if it's available at cheap valuations. And God help you if you ever got stuck into a bad quality business at expensive valuations. Well, all you can do here is pray to Lady Luck to get you out of the mess. If she is not on your side, be prepared to see some big losses. Rahul, all this is good, you may say, but how do we translate this highly useful theoretical knowledge into something that has great practical utility? How can this insight help us make money in the stock market over the long term? Well, this is the beauty of investing. There are no global or domestic standards that you can use to demarcate both business quality as well as valuations. What might be a good business from my perspective may not be so from yours. Likewise, what might be cheap or an attractive valuation for me may well be an expensive valuation for you. Therefore, we may have to use our own yardsticks for separating a good quality business from a bad one. Likewise for valuations also. Of course, these yardsticks are based on our own experience of investing in the stock market, or we could learn from some of the most successful names in the business. Either way, if we don't develop our own yardsticks, we are doomed, to be honest. Ideally, the stock market, or Mr. Market as he is popularly known as, should be our servant and not our guide. We can only make him our servant if we know what quality business to buy and at what valuations. If we have no idea about these two things, then we are eventually letting Mr. Market be our guide, and it is not a good position to be in. We will keep swinging between emotions of greed and fear and end up doing the exact opposite of what we should be ideally doing. We will continue getting greedy when Mr. Market is greedy and fearful when he is fearful. But if we have proper knowledge of what is a good business and what is a good valuation to pay, we can be fearful when Mr. Market is greedy and greedy when Mr. Market is fearful. Now, in one of my earlier lectures on Asian Paints, I spoke about valuations. I spoke about how investing legends like Walter Schloss, Peter Lynch, and Warren Buffett had their own valuation yardsticks. They had an upper limit in terms of valuations beyond which they would rarely go. So that was about valuations. What about the other important element, that is business quality? Is there a proven, reliable way to separate a good quality business from a bad one? To be honest, this is the more difficult of the two puzzles to solve. Determining what valuation multiple to pay and what not to pay for a business is easier than figuring whether the underlying business is of good quality or bad. This is because a lot of things about the business can be subjective in nature. The quality of its management, its future prospects, the prospects of the industry of which it is a part. These are all difficult questions to wrap your head around. One can read report after report on a company and still not be able to decide whether the business quality is worth investing in. It is to be noted that even legends like Warren Buffett and Peter Lynch, with all the knowledge and resources at their disposal, did not quite get the business quality right 10 times out of 10. Even they have failed in assessing the business quality many times in the past and will continue to do so in the future also. So is there a way where we don't have to spend a lot of time in assessing business quality and still not make a lot of mistakes in doing so? You see, I run a penny stock service for Equity Master. It is called as Exponential Profits. The penny stock space, as you would be aware, can be highly dangerous if not analyzed properly. Getting the business quality right is of paramount importance here. I am happy to tell you that I have closed around 27 penny stock recommendations since July 2020 and not a single one at a loss. Yes, you heard that right. 27 positions closed and my subscribers have made profits in every single one of them. The average gain per stock has been close to 80% with a holding period of less than 1 year. So it's an annual return of 80% on an average for every penny stock closed since July 2020. Now, I haven't gone through a single annual report of any of these penny stocks, nor have I built a detailed financial model of them. No brokerage report, no industry report, nothing. I have used a simple method of determining the business quality, and this method has helped me achieve a 100% strike rate. Now, let me be honest, maintaining this 100% strike rate is impossible going forward. The strike rate will come down going forward, but I'm confident that if done right, my method is capable of giving you a success rate in the region of 60% to 70% minimum. And that's not a bad rate if you ask me. So what is this method of determining business quality that does not involve going through annual reports or building detailed spreadsheets? You know, we investors are strange people. We often tend to ignore the elephant in the room and keep obsessing over other small, trivial things. In investing, this elephant in the room is a company's past performance. I don't think people give the past performance of the company the importance it deserves when it comes to judging business quality. Well, I certainly do. I look at a stock's historical performance extremely seriously. If a company has been consistently loss-making or has a weak balance sheet, I don't recommend the stock in my penny stock service, no matter how promising the future of the company is. Take a look at these last 10 recommendations that I closed at a profit in my penny stock service. This table has the historical EPS for the last 7 years and the average debt to equity ratio of the last 5 years. The red colored numbers within parentheses are losses while the other ones are profits. NA denotes non-availability of information. Now, with the exception of KCP Sugar and Satluj Textiles for 1 year and Tamil Nadu Petroproducts for 2 years, none of the other companies had even a single year of losses over the last 7 years. Besides, their average debt to equity ratio over the last 5 years is also well under 1. In fact, some of the stocks are completely debt free. Now, these two data points, that is historical earnings trend and debt to equity ratio, pack a lot of information. They tell you that the company has a sustainable business model, can be relied upon to generate a certain amount of earnings every year, and is conservative when it comes to managing debt. Now, this much information is enough for me to figure out whether I should spend more time on basic due diligence, which should not take more than a couple of hours per stock. And then, if the valuations are also very attractive, I usually go ahead and pull the trigger. So here's how I evaluate every penny stock that I recommend in Exponential Profits, my penny stock service. In terms of business quality, I need the stock to be consistently profitable over the last 7 to 10 years, and I should be able to determine its average earnings power with some degree of reliability. Also, the stock has to have debt to equity ratio consistently below 1. The lower, the better. In terms of valuations, you see the business quality of the stocks that I am looking at is usually average. These are not very high quality, high growth businesses, and therefore I need a big margin of safety so that the upside to downside ratio is in my favor. You can get a big margin of safety only if you're buying it at either close to its book value or paying a very low PE ratio. So that's it. These 2 to 3 factors do the heavy lifting as far as my penny stocks recommendations go, and they have proven to be quite reliable, to be honest. They have helped me achieve a 100% strike rate since July 2020. Okay, now let's evaluate 2 businesses using the parameters I just discussed. These are the profit figures of the 2 businesses for the last 4 financial years. If one goes by my definition of business quality, I will reject these businesses outright because they are still loss-making. They have not achieved profits in even one of the last 4 years. Therefore, there is no point in looking at the debt to equity ratio or even considering valuations. The business quality is bad as per my criteria, and hence we reject these stocks and will only consider them if they record consistent profits over at least 4 to 5 years. Well, in case you are confused between whether to invest in Zomato or Paytm at these levels, then I have made the decision for you. You should not invest in any of these companies, even if they've corrected a great deal from their highs, because these companies A and B are none other than Zomato and Paytm respectively. Yes, you heard that right. These highly loss-making companies are the blue-eyed boys of the startup world, but fail in our business quality test. Therefore, no matter how attractive their future growth prospects, I am in no mood to consider investing in them unless they don't show 3 to 4 years of consistent profits. Well, as I said earlier, investing is simple and you should know how to keep it simple. Making it unnecessarily complicated will make things difficult for you. Hopefully, this video will have given you some useful tips on how to make it simple. Do let me know what you think, and I'll see you again in the next video. Goodbye and take care.